So here we are, the third part of this lecture. And in this one, we will start with a statement of retained earnings. I'm pretty sure you are familiar with. We have talked about a state of retained earning in the past lectures again before. So the statement earning provides an analysis of the change in retained earnings account for a given accounting period. What does it mean? You always have a beginning balance of your retained earnings. Then you add net income, and then you subtract any dividends you have, and that gives you the ending balance of retained earnings. And then this ending balance of retained earnings goes into the stockholders' equity. All right. So this part we also call it closing the net income into a statement of retained earnings. Okay. So accounting for retained earnings, again, the items are net income, dividends, sale of treasury stock below cost, or prior period adjustment. So most likely you're going to see this one. So this is retained earning. This is a beginning balance. This is the ending balance. Here you add the net income. You subtract any dividend you have. And if you have a net loss, will also go over on this side. Okay. A statement of stockholders' equity. How does it look like? Integrate information regarding retained earnings into a more comprehensive stockholders' equity. It's over here. As I said earlier, equity shows an analysis of all the stockholders' equity, all accounts, again, common stock, preferred stock, additional paid-in capital, retained earnings, and treasury stocks. I'm just putting it because it's on the debit side. These are on the, and the dividend, sometimes they like to mention over here as well. All right. It refers to a stock shareholders' equity or owner's equity, has four major categories: contributed capital, paid-in capital. Paid-in represents amount invested by the stockholder. So this is the paid-in capital, PIC, paid-in capital. This is all included in it. The face or stated value on the is its par value, which is right over here. The next thing we're going to talk about, retained earnings or cumulative retained earnings, is right over here. And then stock also refers to shareholders' equity, owner's equity, has major categories. So we're going to talk about here is also called contributed capital, paid-in capital, invested by the shareholders. So this money, the common stock, the preferred stock, additional paid-in capital, coming from investors. This retained earning is coming from the business because it's an accumulation. Treasury stock, whatever you have purchased or sell, and dividend, whatever you have given back to the investors. Okay. Next, we're going to talk about types of dividends. We have cash dividends, we have stock dividend, we have property dividends, we have liquidating dividends. Liquidating dividends when you are going out of the business, basically. Accounting for cash dividend, these dates are very important. Declaration date, the date on which the board of directors declare that they are going to give their shareholders a dividend, and this becomes a liability. So on this date, and that's the record date. Also, declaration firm determines the register. So on this date, it becomes a liability. You say debit dividend, and you credit dividend payable. The record date is usually set as they say February 15. They're going to say how many people on this day, end of the business days, means after 5 p.m. holding the shares. And this is the ex-dividend date. Date determined relevant to stock exchange, generally 2 business days before the record date. And the payment date. On the payment date, you send a check, you debit the dividend payable, and you credit cash. The checks goes out. Okay. If you are giving them accounting for stock dividends instead of cash, the declaration of stock dividend does not lead to a legal liability. So cash dividend is a legal liability, cash dividend, legal liability, but stock dividend is not a legal liability. A stock dividend do not change the equity balance. Retained earnings are decreased, contributed capitals are increased. So basically you debiting the retained earnings but crediting common stock, for example. Common stock is going up, retained earning is going down. Analyzing one of the primary measure of overall company performance. So what we do, we calculate the return on stockholders' equity. We take the net income, we subtract the preferred stock dividend, whether paid or not. Whether they paid it or not, we still subtract it and we calculate with the average common stockholders equity. Means you take the beginning balance and plus the ending balance and you add them and divide by 2. That's how you got the. So higher the ratio, the higher the profitability of common stockholders. Okay, always remember this. Then the next one is analyzing dividends policy. Some investors prefer receiving current income in the form of dividend. Some investors rather the corporation not pay dividends so the stock will appreciate more. So why do this thing? So let me share with you. If a company is new, means you just formed the company, like Microsoft in 1980. They don't want dividend. They want the company to invest money in the company, and that's share prices go up. So, and that stock split happens. So they get more shares and they can sell the shares in the market at a later date and make the profit this way. Dividend, when investors are requiring the dividend because they believe the company is running out of ideas, they do not have good ideas for new products or services, so they want to have dividends. This is another way of looking at it. There are certain industries, they are highly regulated industries, very mature industries such as utilities companies. Utilities companies pay dividends on a quarterly basis. Okay, one measure of dividend policy is the dividend yield. So how we calculate the dividend yield? We take the annual dividend per share. Say for example, they gave you $20 per share, and the market price, the price at which the share is selling, suppose they are selling for $30. So you got basically 0.66. The dividend yield measures the rate of return in cash dividend from an investment in the company's common stock. So suppose the market price per share, what was $30, you receive $20. So you receive basically 66% return. The dividend payout ratio measures the percentage of net income available to common stockholder. Means what percentage of the net income in that year goes to preferred and what in net income goes to the common stockholders. Dividend payout ratio is equal to annual dividend per share divided by the earnings per share. So earnings per shares are calculated net income minus preferred divided by average common stocks outstanding. So that's how earnings per share is calculated. Growth companies typically have low dividend payout. Means growth companies means new companies, since they would rather use their cash to fund additional growth, while more mature companies lacking growth opportunities have a higher dividend payout ratio. Okay. Earnings per share is probably single most widely financial ratio. They also have to report this on the income statement. This is the formula. Price earning ratio, another widely used financial ratio on the return on equity, which tell us about amount earned for each dollar invested by the common stocks. So return on equity is calculated by dividing net income less any preferred dividends by average common stockholders equity. So that's how we calculate the PE ratio. If you have any questions, please let me know. you are watching my videos. Thank you very much. If you could please provide your feedback on these videos, I would really appreciate it. Thank you.